All right, today we're going to pull back the curtain on one of the most stressful, high-stakes moments for any startup founder: valuation. We're going to break down the exact playbook investors use to put a number on your company. Just imagine it. You're in the room, you've just poured your heart and soul into the pitch of your life, and then the investor leans forward and asks that one tiny question. And for most founders, right, this is the moment your heart just stops. What do you even say? So let's start right there. Let's dig into why that question feels so impossible to answer, and look at the typical and, frankly, often wrong ways founders try to come up with that magic number. And this is where you see the huge difference. On one side, you've got the founder. Their approach is often, a mix of gut feelings or vibes, looking at what similar companies or comps raised, and maybe just throwing out a high number to see if it sticks. It's a lot of guesswork. Meanwhile, the investor, they're running a simple, repeatable model. They are not guessing, not at all. Okay, so what is this so-called secret model? The truth is, it's not really a secret. It's a method that's been the bedrock of venture capital for decades. And once you understand it, the whole negotiation changes. It's called the venture capital method. And at its heart, it's a way to value a startup not based on what it is today, but on what it could become. The whole thing works by starting with a massive number in the future, the exit, and working backward. And this is a huge shift in mindset, For a brand new company with maybe no revenue, today's cash flow it's pretty much meaningless. The only number that truly matters to an investor is the potential payout when the company gets bought or goes public. It is all about the exit.
So how does this actually work? Let's get into the numbers. Don't worry, it's simpler than it sounds. We're going to walk through exactly how an investor starts with a big dream in the future and turns it into a hard number for today.
It all starts with a target. So let's just throw a number out there. An investor looks at your company and thinks, yeah, in about 5 or 10 years, this thing could realistically sell for $100 million. That's not a random guess. It's based on the market, other exits, stuff like that. And that's step one, forecast the exit value. Next, the investor applies their required return. Look, early stage investing is incredibly risky. Most startups fail. So for the ones that actually win, they need a big win. A 10x return on their money is a pretty common target. This little multiplier, it's the key to the whole thing. Okay, so let's put it all together. Step one, they forecast that future exit, or $100 million. Step two, they apply their required 10x return. So what do? Step three, they just divide that future exit by 10 to get today's value. So $100 million divided by 10x, bam, that's a $10 million post-money valuation. That's the absolute max they can agree to after their investment. From there, step four is easy. If they're investing $2 million, they need 20% of that $10 million company. See, it's just a path from a future dream to a present-day number.
But hold on, we're not done. Because raising money isn't a one-and-done deal. It's a multi-round game. And that very first valuation you set has massive ripple effects that you'll feel for years to come. Let's get into that. This quote from the source material just hits the nail on the head. So often, founders get laser-focused on winning the battle of this one round that they totally forget they're fighting a whole war. They're not thinking about the Series A, B, and C down the road. So let's look at how this plays out. After your very first round, the seed round, things look pretty good, right? You, the founder, you still own a massive 80% chunk of your baby. You're feeling great. But then the Series A happens. You bring in a new investor, you set up a stock option pool for your employees, and boom, suddenly your piece of the pie is smaller. And so is your first investors. This is dilution, and it happens every single time you raise more money. And that's why this is so important. That first valuation sets the trajectory for every round that follows. If you aim way too high and you can't grow into it, your next round could be a down round at a lower valuation. And trust me, that is an incredibly painful experience for everyone involved. Getting that first number right is absolutely crucial. So this brings us to the big takeaway. Now that you know the investor's playbook, how can you actually use this? Well, it's all about connecting your grand vision, your amazing story, to the cold, hard numbers on a spreadsheet. And this is what it looks like in the real world. This is basically a simplified version of the cap table model VCs are building. It shows exactly who owns what percentage, and here's the key part: what each of those slices is worth if there's a big exit someday. This is the math that decides who gets rich.
By understanding the venture capital method, you are suddenly empowered. You can answer these critical questions with confidence. You can walk into that meeting and justify your valuation with actual numbers, not just hopes and dreams. You can model out how much equity you're giving up and understand what a future exit really means for you and your whole team. And that leads us to this powerful final thought. The story gets you in the door. Your vision, your passion, your narrative, that's absolutely essential. But the moment that spreadsheet comes out, the conversation changes. It becomes math. So the final question we'll leave you with is this. You've got a compelling story, no doubt, but is it backed by math? Because the investors in that room, you can be sure their story is. Now, yours can be too.